Hello and welcome to Gold and Silver Assets. I'm Diora and it's Sunday the 18th of April 2021. Why do you own gold and what are your expectations of it? I think there are a lot of people out there who invest in gold or choose not to invest in gold, all for the wrong reasons. What is the role of physical gold in your portfolio and what can you realistically expect from it? We've all heard about how amazingly well investments such as Tesla and Bitcoin have done over the last couple of years. And this chart shows the percentage gains since late 2018. The blue line shows the Tesla has gone up 1200%. The black line shows Bitcoin, which has gone up 800%. And in orange, we've got poor old gold, which is only up a double figure percentage. This makes gold look pretty bad. And look, you can't really argue with these figures. Certainly huge profits have been made in Tesla and Bitcoin. However, this isn't a sufficient argument against investing in gold. And I'm going to discuss why. Unless you've got balls of steel and go all in on a single asset, investment portfolios usually have the following components. Defensive stocks tend to be relatively stable regardless of the state of the economy. They're not cyclical and they include things like utilities and consumer staples. You could have a component that provides income, such as dividends, interest payments, or rental income. Insurance can come in a number of forms. For example, it could be an asset that's negatively correlated to the stock market, so its value rises when the stock market drops. It could be buying a put option on a stock to offset the risk of an adverse price movement. Now look, these three components are often seen as being rather boring, and actually the one that gets the most attention is the speculative part, because that's where the massive gains can potentially be made. Now people also differ in terms of what proportions they allocate to each component, depending on their risk appetite. Let's look more closely at those last two components. The aim of the insurance component is to avoid or minimise loss. Let's be clear about this, it's not aimed at making gains, and that's something that's often misunderstood. Look, you don't buy house insurance to make a profit from it. And the same goes for investment insurance. Also, insurance is something that's used over a very long time horizon. Again, you don't buy house insurance with the intention of only holding it for a year. Speculative risk is a whole different animal. The sole aim here is to buy something with the aim of selling it for a profit. This inevitably comes with a risk of loss, and this risk can be substantial and losses can be large. There's even a risk that the value of a particular asset could go to zero, it could become worthless. However, such risks are accepted in the hopes of potential gains, which can be substantial. Speculative assets usually occur over a relatively short time horizon in terms of the investment. So if you bought a speculative asset, you wouldn't expect it to keep rising up until 20 years later when you aim to retire. That's not realistic for these kinds of assets. Now here I do want to make a distinction between speculative risk and asymmetric risk. Now there can be an overlap between the two, but I do see them as being different in a few ways. Yes, there is a risk of loss, and again that risk can be substantial depending on the type of asset you're looking at. But that doesn't mean that the risk extends to the asset becoming worthless. The key point here is that the magnitude of the gain is substantially greater than the magnitude of the loss. But perhaps even more importantly, the probability of the gain is substantially greater than the probability of the loss. I also suspect that investment in an asset with asymmetric risk can cover a wider range of time horizons than speculative assets. Okay, so how does all this relate to physical gold? What is the place of physical gold in your portfolio? For many centuries, gold has been used as a savings vehicle for people at all levels in society. The thing is, though, particularly in the last 40 years, gold has been supplanted by various fiat products for this purpose. Gold has historically been proven to be highly effective for preserving wealth. And when you think about it, those rich families who are able to preserve their wealth over multiple generations did so using three asset classes: real estate, fine art, and gold. As long as there are humans on the planet, I think I can be bold enough to say that gold will never be worthless. Gold can also be considered as insurance against inflation and currency devaluation, geopolitical turmoil, and bank failures. Now, these are all things we don't want to see happening, but if they do occur, you want to be covered for those things. The problem is that these days there are many who think of gold as a speculative asset. Now, given what I've already discussed, that would suggest that gold is actually insurance rather than speculation. So why do people try to use it as a speculation? Well, I think the reason is that the valuation seems to vary. And there are times where gold is undervalued, and there are other times when gold is overvalued. Now, this hasn't been the case historically. This chart shows in red the purchasing power of gold in the UK from the 1500s to 2015. Note that before 1913, the purchasing power of gold has been relatively flat, although there is some fluctuation. It's not wild. However, after 1913, you can see that these fluctuations have been much greater. This purchasing power has been very volatile. And I wonder if it's this variation that has introduced that speculative mentality regarding gold. On this chart, we can see that the best times to buy gold were here in 1920, here in 1970, and here in the year 2000. And the other thing to note is that the general trend for the purchasing power during that fiat era has been upwards. We can see from this chart that during the fiat era, it has been possible to purchase undervalued gold. But one of the problems we have is distortion of the data that can mask the undervaluation. The problem with using this measure of purchasing power is it relies on official data, so things like the CPI. And as you've seen from my previous videos, this can lead to distortions and misinformation. One way of assessing gold valuation is to compare it to the M2 money supply per capita, which is shown in blue, and in orange here we've got the gold price. Now, this chart suggests that gold was undervalued over here in the year 2000s, and here it was vastly overvalued in 2012. Now, on the face of it, this chart looks like it's pretty useful, and it tells us that gold is currently fairly valued here. But let's have a closer look at this chart. So one of the things we can see is that the data was indexed to 100 in 1973. Now, indexing is a useful thing to do here, but why was 1973 chosen? What's so special about that date? Look, I don't know the answer to that, but what I do know is that knowing which date it's indexed to is actually very relevant. If I were to change the index date to 1981, then we get a very, very different picture here. This suggests that the gold price is 4 times undervalued compared to the money supply. Now, this was done on TradingView, and it's slightly different from the other chart in that it's just pure M2 money supply here. It's not per capita. And that's just because I couldn't get that data on TradingView. But from what I can tell, if you change it to per capita, it basically just changes the slope, but doesn't really affect the trajectory. So I think that this is still reasonably valid. But what about if we changed the date to the year 2000? Well, that makes gold very overvalued at the moment. And if we change the index date to 5 years earlier, so that's 1995, well, that makes gold slightly undervalued. So you can see that we get multiple results depending on the index date. What's the correct index date that we should be using? I wanted to try 1971 based on the fact that, that's when the dollar went off the gold standard. But the data in TradingView doesn't actually go back that far, so I couldn't do that. I think a better way of using that data is actually to use ratios, and that gets rid of that indexing problem, and it gives you a better idea of valuations. So this basically shows the ratio of the M2 money supply to gold. So the higher the ratio, the more undervalued gold is. So over here, gold was very undervalued, and down here in 1981, gold was very overvalued here. So yeah, this could be useful in giving us gold valuations. But of course, the problem we're going to come up against now is that, of course, a lot of the money supply data is being discontinued. So let's go back to our original discussion. And basically, in conclusion, there are people that treat gold as a speculative asset due to its variation in the valuation over shorter time periods. However, we know that assessing the valuation isn't that easy, and the gold price is affected by multiple factors, including manipulation. Therefore, using physical gold as a speculative asset is very likely to lead to disappointment. If you're thinking of physical gold as a speculation, you're doing it wrong. If you're looking for huge gains in a short amount of time, there are plenty of better options out there. Gold is not what you're looking for. Now, although I don't think it's great as a speculation, I do think that there are times where it presents opportunity in the form of asymmetric risk. I think physical gold should be considered as a form of savings, a way of preserving your wealth for your retirement or even for future generations. And gold has proven itself in doing that reliably for many centuries. Gold should also be considered as insurance against financial and geopolitical turmoil. And I think this is something that's particularly important to have cover against, particularly when we're in the current environment. The other thing to remember is that the higher the price of gold, the worse the state of the world will be. So it's not like other forms of investment. And actually, we should be hoping that this type of insurance doesn't pay out. Next up, the market update. Let's start with gold priced in US dollars on the daily scale. And this is looking pretty good, isn't it? This is looking more and more like a double bottom. Price has moved up from there, so we've had a breakout from that double bottom here. And when it broke out, it kind of went back to have a retest and then moved on upwards. And this was pretty nice movement here. I'm pretty happy with that. And we can now confirm that we are in this uptrend here. So we've got higher lows and higher highs. So that's looking good. I think we're going to keep moving up for a while now. Of course, we've got to think, where are the setbacks going to occur? Well, if we look over here, I think there's going to be significant setback here at around the 1825 level here. So I think that's the next kind of major point where we could see another big drop downwards. Now, one thing we could do potentially is draw a trend line. We've only got 2 touches here, but that could give us an idea about where price could dip down to. So that's one possibility. Sometimes price actually moves even faster than that. So I don't know if that's going to hold. But yeah, let's look out for around that 1825 level. And then, of course, the big one is this line here, which is that longer term trend line, which you can see on the weekly scale, which kind of defines the upper channel for this correction here. And so that would lead us to around 1875, 1880, depending on when we actually get there. But that's going to be really important there. If we get a breakout from there, then that's going to be very positive. And of course, the next target is that previous all-time high, just above $2,000 there. As I said, I'm bullish, and so my bias is going to be to the upside unless we see otherwise. Of course, if price turns around, we would need to have a new low below that, so below around 1677-ish. Then I think that would be really bad news. Look, I don't think that's going to happen though, just from the way the chart's looking, and also the way the miners are looking as well. So yeah, I'm still bias bull here. Let's look at silver priced in US dollars again on the daily scale. And we were talking about this descending wedge pattern, which is bullish. We had a breakout from that. We had a retest, and it actually retested that line twice. And, you know, this is one of the problems here, is that it's not an exact science. You know, look, it did dip slightly below it and then, of course, recovered pretty well and came back up again very strongly, actually. And price has just continued on upwards since then. And I had mentioned previously that this $26 level would be a bit of a setback because of all this action here and even further back as well. And we did get some rejection over here, and that's why we've got this long upper wick over here. It just couldn't maintain above that price. So where do we go next? Well, one of the things here is that we do have this long upper wick with a small body. If we get follow through, meaning if we get a red candle on Monday, then we could expect a bit more downwards movement. If that were to occur, then we could potentially use this as a potential downside target, which would be about 25.3-ish, and we'd have support there, both because of this line here, but also we've got a bit of price action there that suggests that that could be support as well. But that doesn't necessarily have to happen. If we get a green candle on Monday, then this could actually hop up and we'll be back into this zone here between 26 and 28. And if that happens and we get a close in that area, then I would expect 26 to be support again. And look, overall, this is a bullish pattern and the target is $30. And so that's what I'm going to be working with. So that's the trajectory, and you know, we're going to get ups and downs on the way. And the other thing is, I don't know how long that's going to take. Often with these kinds of shapes of patterns, the moves can occur quite rapidly. I mean, I've had some where it's come above this line, it's just shot up, you know, halfway to the target in one day. So some of these can be pretty sharp moves here. So yeah, I don't know how long this is going to take, but I suspect it's going to be a little bit of work. Once we get into this zone, then particularly once we get to 30, after that, look, we just have to see how things go. A break above 30 is going to be absolutely huge because there's quite a lot of thin air up there if we look at the weekly and monthly charts. But I think we've got a way to go there. So we'll talk about that as we get to that. But yeah, basically, I think in the next couple of weeks, we're looking at a target price between $26 and $28. And the miners are looking very good, aren't they? So this is the GDX on the daily scale. And I've drawn two lines here because, again, this can be argued. There's so much subjectivity with these charts and how we interpret them. So with this maroon coloured line, what I've done is join those two highs here. And so that gives us that line. And in fact, that actually turned out to be quite interesting because price kind of formed this consolidation area just underneath that line before breaking through there. So that looks like it's a pretty good valid line, I think. Another option is to join the absolute high over here, and I've joined that with this high here again. And so that gives us a slightly shallower slope. But again, we've broken out above that, and actually price closed just on that line there. So I think, personally, I think I would use this red line and I think we've broken out here with the miners. And so I think they're on the up, and we've got quite a high up target here if we look on the monthly chart. So I think they're going to do really well. In the shorter term, it looks like we've got a bit of a double bottom here. Price broke out above it, just got knocked back a little bit and then moved straight through there. And so, you know, this would give us a target of around 38-ish in the first instance. And then I think price is just going to move up pretty well here for the miners, I suspect. We could get a bit of a knockback. Sometimes this line can get retested, so there is that possibility. I'm not convinced it's going to go that low, to be honest. I actually think that it's just going to move up before coming back, and maybe it will retest this line instead. But yeah, very happy with the gold miners. And certainly also the individual ones seem to be doing pretty well this week as well. And finally, we have the junior silver miners. That's the SILJ on the daily scale, and it's been quite a long time, hasn't it? And prices have been moving sideways, and it's pretty boring to talk about, but yeah, here we are. Anyway, again, I think it's still looking promising. So we had this up move here, and then we've had this nice consolidation here, and that makes me think that this is a flag on a flagpole, in which case this is going to take us up to our target area here. And this is the big one. This is the big line that we really want to cross and sustainably close above. We actually want price to go above here and find support at 1750. And then I think we're going to be on a nice roll for the silver miners as well. So, you know, some might say, oh, well, are we just going to go back down here and go up and down for longer? Look, that's possible, but it's just the way this price is behaving over here, which we didn't really get before that. So yeah, I just think this just looks really nice, a nice tight pattern, and the target level is where we want it to be as well. Now, when we get here, it might knock back a bit and consolidate a little bit before going through there. That's possible, so just bear that in mind there. But I don't think we're going to go back below the midline here somehow. Anyway, that's just a hunch, I don't know for sure. But I think it's looking even less and less likely that we're going to break below this line over here. So I don't think we're going to get below 1350. So overall, I'm pretty happy. Anyway, hope you're all doing well. Don't forget to like and subscribe. All the best, and see you next week. Bye.